Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. I'm so excited for the podcast today. We have a fantastic guest. Adam Hughes is the CEO of Amount, and we're going to learn about the digital lending industry, buy now, pay later, as well as the trends of working with large banks and enabling their digital transformation to access some of these themes as part of embedded finance and banking as a service. And so with that, let me welcome Adam to the podcast.
Thanks, Lex. Really excited to be here. Thanks for having me on.
Absolutely. My pleasure. So I want to just start with your journey into the fintech space and digital credit, digital lending space. Can you tell us a little bit about how you got started?
Yeah, how I got started, I graduated Northwestern here in Chicago, went to work in strategic consulting for a number of years and got early promoted, but then picked my head up at 2 years and 2 months. And I remember that exactly because that's the average span of a consultant. Because you get fairly burned out traveling full time. And I started off traveling, living out of a suitcase Monday through Thursday. That extended to be Monday to Friday. And after I got promoted, I started looking around. In my stint in consulting, I was heavily focused on working with banks. And so during that time in my early 20s, really became familiar with banks' technologies and understanding areas of opportunity, of potentially where I could help. Left that consulting firm and started looking around, got offers from a few other consulting firms, but recognized that I really wanted to make a bigger impact. And it was hard to do that in your early 20s at a large hundreds of thousands of person company. And so started looking at startups at the time. Back in 2005, startups were less cool as they are today, and got an opportunity at a company called Enova here in Chicago. Ended up joining the firm, was employee 40 there. And Enova's vision was to really be the shining light in the subprime lending industry. In that industry, lots of offshore illegal payday lending models that were just really broken. And Enova's model at the time was provide that subprime borrower a much better digital experience and ultimately much more affordable pricing. Enova, large publicly traded company today, continues to do that. But what we recognized in my time at Enova was the similar issues that exist in the subprime space exist in other areas of the credit spectrum as well. And so saw a very similar opportunity to really help what we call the near prime space. Customers with an average FICO of 650, so certainly not subprime, but still were being left behind by the banking industry. And that 650 average FICO score customer was really settling for the subprime products. And our view was they really shouldn't have to. And using best-in-class technology and more sophisticated underwriting methodologies, very similar thesis was we could provide that customer a much better digital experience when applying for credit, and ultimately much more affordable pricing, both because one, we could underwrite better, and two, we didn't have a branch network, and we drive a lot more of that cost savings back to the customer.
Can I ask you to give a little bit of like an emotional or psychographic profile of what is this subprime, customer? What is this near prime customer? What kind of people are we talking about here? What's an example of their financial situation?
Yeah, the typical Avant customer, 650 FICO, about $55,000 of average household income, maybe has one or two late payments on their credit bureau, which is really ding their credit score in the short or near term. For those customers that are looking for something like a personal loan, for a credit card, they're often getting declined. And because of that, and they need credit, they're often settling for really subpar options. And so our vision at Avant was, again, that this is a massive pool of customers that are being dramatically underserved in terms of A, having to settle for a brick and mortar experience going into a physical branch and waiting 5 hours to get approved for a loan, or two, having to settle for a high APR product. And given our experience at Enova, we took a lot of those learnings and were able to provide that customer a much better product, a much better experience at Avant. And so at Avant, was employee one, helped start the business back in 2012, became the president, and over 8 years, grew a really successful business. Over 1 million customers were originating credit on the Avant platform, about $9 billion in total, 90% of which we balance sheeted ourselves. And why that was really important is we were eating our own cooking. And it was really important for us to become experts around things like underwriting and digital fraud prevention and account management, in addition to the table stakes UI UX, what it takes to build a best-in-class customer experience when applying for credit products. We recognized after doing this for a number of years and really being disruptors in the space that when we picked our head above water in 2016, the tech we had built for Avant was really light years ahead of every single bank that we were dealing with. Many banks still require customers to go into the branch to get basic branch-based retail products. For customers with any kind of not even a red flag, any kind of flag around something like verifying their identity. Maybe they have a new license. Maybe they fat fingered their SSN. They were thrown into a manual review process, which can take weeks. And so the Avant tech, light years ahead in terms of that table stakes digital customer experience, but also the modules that we built on the platform around fraud prevention, underwriting, and account management. We recognize a clear opportunity to white label that tech and start to power and partner with banks to accelerate their digital strategies. And so effectively created a side business. We called it Powered by Avant. But very quickly, we found product market fit and big partnerships with banks like TD Bank, HSBC, BBVA, and others to power, various digital strategies that the bank had, primarily around retail lending. So very quickly after that moment, recognized that one, this was a standalone software business, and two, a very different business than Avant. Avant was a direct-to-consumer lending platform. Powered by Avant, now rebranded to Amount, was a SaaS business that was primarily focused on partnering with banks. And so spent the next several years making plans to spin out that technology. We did that January 1 of 2020. I came over from being president of Avant to being CEO of the now rebranded Amount. Avant transitioned to be a customer on the Amount platform, so very akin to our other banking partners. Avant today goes to Amount for their tech and data needs. And we were off and running. I became CEO in February of 2020. A month into my tenure, a pandemic hit. And so that was definitely a trial by fire that within 45 days, I was transitioning 300 plus employees to work from home. We did that, we think, really effectively, and very quickly recognized that what was obviously massive questions around the world of what this pandemic means. From a business perspective, there was a big opportunity for Amount because every single bank CEO under the sun was dramatically increasing the priorities for digitizing their branch experience because customers weren't going to branches. And two, e-commerce was exploding, and in parallel, this new buy now, pay later product was increasing in attractiveness as well. And Amount is uniquely positioned because we have world-class solutions for both those things. And so we can get into it. Sales pipeline increase, attracted a lot of private equity capital, and it's been quite the journey from when I started my career back at Enova to where we're at today in Amount.
Yeah, I can imagine 2020, right? It's the on deck moment, I think, is one that definitely surprised me because I remember covering on deck and just seeing $1 billion fintech dissipate is like a really stressful signal, while in fact it was the opposite thing happened, which is that digital distribution became accelerated by probably about 5 years. But I think this also points to a fact about digital lending. And I want to rewind a little bit back to your experience in Avant, because I think you were there during a time when the fintech industry really got defined and developed, and my mental model for that moment, like mid 2000s to mid 2010s, is that distribution across every asset class in fintech changed from going in the branch, going to a loan officer, going to a financial advisor, going to some insurance salesperson, into just a digital storefront. And it's an easy story in that you get your you get your digital bank account, you get your loan digitally, you get your asset allocation digitally, and then you get your payments digitally, and all of it is in a mobile app or in a website. But I think there is a second and quite different attribute for digital lending, which is that you're not just selling an asset allocation, you're not just selling the movement of money, where the product is quite orthodox. Like there's not, you don't need to exercise that much judgment, but you are underwriting. And underwriting, the bank story around underwriting is always like, we have all this data and therefore our math is the best. And of course that's not necessarily holding up over the long run. But I wanted to just meditate a little bit on your reflections for how consumer B2C digital lending changed over that period, that inception period that you were talking about. And then separately, kind of, if any insights around also having to build out an underwriting engine in addition to having to build out a consumer distribution footprint.
Yeah, great questions, and there's a few in there that I'll try to unpack. When we were starting Avant, we were seeing lots of banks not focusing on the origination of unsecured consumer credit, and they had really moved away from that after the Great Recession. And so companies like Lending Club and Prosper and On Deck in the small business side were able to take market share because banks either weren't focused on that, or B, banks had a fairly clunky experience. And fintechs like Lending Club and Prosper and ultimately Avant were able to immediately carve out a niche because of that, again, that elite customer experience. And because it was able to really hit the needs of that growing expectation for customers around digital. Customers were just starting to be able to use their phone for buying things and ordering food, and Uber was a concept that was just starting. And so by able to start to take some of those mobile themes and put that into our business, customers really liked it. And so NPS scores were 70 plus, and you think about how that compares to an NPS score of a typical bank in the low single digits, sometimes negative. Very quickly, without a brand, Avant and those other fintechs were able to grow a large customer base without a brand because, based on customer referrals and just an elite understanding of around what it takes to effectively run a high-end performance marketing campaign, the right way to balance customer experience with risk mitigation around ID, income, and fraud risks, and the right way for a customer to self-service their loan or credit card once that product gets funded. And so by just driving that customer-first experience all around a digital and mobile-first mindset, fintechs really started to take more and more market share, with banks being less focused on that part of the business.
But there's also one thing you mentioned was around how much of the underwriting was your own balance sheet, and that I'm not going to say it's unusual, but that's like a model out of a couple of different models that were being developed at the time, right? So you had attempts to do completely peer-to-peer networks. You had attempts where private equity and hedge fund capital came in, which I think loops in with some other points you're making. And then you had bank partnerships and so on. Can you talk a little bit about the decision trees around that? Like, why do you build it? Why were things built one way or another? And kind of, how do you think that entire experiment shook out?
Our initial thesis was, if we were going to build a long, stable, and healthy business, it was really important for us to have that balance sheet model. And for loans that we would be comfortable originating, we should be comfortable balancing and taking on the credit risk of that products. And so really having that immediate insight around credit performance for us was really important in allowing us the flexibility to make quick tweaks to that model. Now, what that allowed us to do is really become experts around things like testing and digital credit underwriting, and most importantly, that fraud prevention piece. We started off those first couple of years and certainly lost money around fraud prevention. But after 8 years and hundreds of millions of applications and billions of dollars of credit that was originated, the Avant data plus all the consortium data we have today with our bank partners, there is a highly sophisticated and predictable amount fraud model that banks really value for us. And what we find is, with that both experience and all the fraud capabilities that's under the hood, that's really what sets Amount apart. Because there's lots of fintechs out there that can provide a bank a better digital waterfall experience. And again, for us, that's really table stakes. What the real value is here is helping a bank or a partner build a large, profitable digital portfolio. And the combination of our experience and everything that we've built in terms of that underwriting tech and that fraud prevention tech, we're seeing more and more often we're put up against either the bank's internal capabilities, an established player, or another fintech. We're winning that deal because, especially when you're talking to a credit professional or a senior retail leader at a bank, they really value that because this is often their first time of having a true digital experience for that customer, not just a digital application. Lots of banks have that, but a true soup to nut end-to-end origination, and in some cases taking advantage of our servicing tech as well to really stand up a large portfolio and having Amount be there with the experience, with all the tech and all the analytical capabilities, has been really valuable for us in building our bank partnership business.
Yep. We'll open up those topics in a second. I've got one more on the underwriting bit, because again, I think for our listeners who focus on multiple different asset classes, I think this is key to understanding the difference between digital lending versus the models that were built for investing and just digital banking and payments. And that is that digital lending touches the manufacturing of the actual loan a lot more than some of the platforms that focus on these other industries. In your journey to build that underwriting engine, I guess, what were the scales at which the data started to feel good to you? Like, how quickly did the loss ratios improve? At what scale do you start saying like that there's high confidence in sort of the hardening of the models and the manufacturing of the loans? Does that make sense as a
Yeah,
question?
yeah. I mean, really about 2 years for us to have one, the number of applications you need to have the right sample size and performance data. Again, this is typically a monthly payment that the customer is making, and so you really need 24 months at least performance data, both good and bad, to really understand what's going on, both from an underwriting perspective, so a credit perspective, as well as starting to identify, really digital fraud trends and how to prevent that. Number two, we took the approach of not only feeding data into a machine learning module that was getting smarter, but also doing manual reviews on the amount side. And over the last 8 years, 60,000 plus manual reviews of individual accounts where our fraud team is going in and identifying exactly what happened between first party fraud, third party fraud, and feeding that back into the model. And so the combination of the data points we have from the Avant days, all of our bank partners, as well as this manual tagging, has provided a really powerful, highly predictive model that can really identify a potential risk. And then we've paired that with a really sophisticated mitigation platform. And so a bank not only can feel comfortable that we're going to identify that risk for them, but also they're going to have those automated mitigation strategies to get comfortable with that customer in real time in an automated fashion. And so whether or not that customer's ID, income, employment, something else gets flashed, we have various waterfalls that we recommend that the bank has full control over them, they can tweak to really put that customer through various strategies to really make sure that they are who they say they are, they make what they say they make, and they work what they say they work, or anything else that the bank has in their underwriting criteria to get comfortable funding that various credit product. So experience, certainly data, which takes some time to build up to really get to a place where you can really trust it. And then three, really that manual review, which sounds fairly simplistic, but it takes time. It takes a long team to do. Really what we found is taking that product and that tech to the next level to make it really powerful and value add for the bank at the end of the day.
Yeah, that's super helpful. Thank you. Two asides that I think are just interesting analogies. So Pandora, which was the Spotify before Spotify, Pandora, the music service, had, I wouldn't say it was a machine learning algorithm, but it was a statistical algorithm that recommended to you kind of like custom music that you like. And it was built in the early 2000s before they could really kind of machine scan all the music files and determine kind of cadence and all these attributes. And so they indeed had just master students in music theory every day tagging every single song in their collection in order to teach the machine, in order to give custom recommendations to people. And you can't underestimate the amount of sausage making that's required to teach a good math equation to do the type of work that people want.
Yeah. I mean, that analogy is definitely spot on. It brings up, if you watch the show Silicon Valley on HBO, when they built the hot dog app and all the tagging they had to do around food, we think we were much more sophisticated than that in terms of the manual reviews that we're doing. But certainly an element of, you can be as sophisticated on the data modeling side, but if you don't have some of the qualitative feedback and insights, it's just not going to hit the mark. And so balancing those two is really important when building again, a product that is going to allow you to do massive scale when you're talking about unsecured credit.
Right. And so switching over to Amount, I think the interesting might be the wrong word, but one analogy is if you think about spam for tech firms, there has to be an industry-wide solution to spam. So for Google to develop its own technology and for Microsoft to have a different one and so on makes less sense, because in a way it's like a horizontal layer that you need to tag bad actors. And so this is a type of functionality that makes sense to become really big. And so it definitely makes sense to me, the story that Amount would expand from just Avant's customer base and also connect into HSBC and Barclays and TD and all these other banks and kind of leverage the collective data set, because fraud and kind of scams and things of that nature are this big kind of at scale industry problem. Can you talk a little bit about how that expansion happened? Like, was it hard to form these partnerships? Was it hard to get access to this data? Because I know certainly a couple of years ago, you'd still have fairly traditional views towards data sharing from these institutions.
Yeah, it certainly wasn't easy from the standpoint of, back in 2016, a few of the early partnerships we did, we were the first partnership the bank had done with the vendor being in the cloud. And so that was number one. And so had to really get the banks comfortable from an information security perspective, and we were able to do that. Number two, from the perspective of, hey, you can have the best technology and have the best pitch, but how do you truly get a leader to say yes, especially when they have a predisposition to go to their internal teams and build it themselves? And our approach was, we had the product, we had the experience, but going to them with a model that made it really easy for them to say yes was important. So that model was, we went to 100% transactional is how we got paid. And so what that means is, we didn't have a platform fee in the early days. We went to Bank ABC and said, hey, we are only paid if you successfully fund a credit product. And then we're going to take a percentage off that credit product. And so we're really sharing in that upside together. If you don't originate anything, you don't pay us a dime. But as that product grows, because we're doing our job from that tech experience, as well as protecting you from a fraud prevention standpoint, so your risk teams are getting comfortable, your compliance teams are getting comfortable, we can share in that upside together. And that was a really powerful message for the early banks to say yes. Then after that, it was just building credibility. We're a bit unique, from my perspective at least, that we started with really large banks. I see lots of fintechs that start small and try to work their way up. We started, obviously, large banks, $50 billion plus, and we've been able to build a lot of credibility that our platform can handle the customization and the scale that an enterprise bank really demands. And so because of that, of the success from the early days, making really easy for the bank to say yes, really becoming experts of not only technology, but also how do you actually navigate your way through the procurement process at a large bank. That's allowed us to really understand, hey, where are some opportunities that we can start to play down market as well? Because the same challenges that banks have up market around providing an elite digital experience to a customer, meeting the customer online versus them not wanting to go in a branch, and then buy not pay later, which we haven't even talked about. Medium and small size banks have those exact same challenges, often more so. And so, we've tweaked our model a bit in terms of, for the larger banks, we do today have a more traditional SaaS platform fee, still a variable fee on top. But really, as we think about going down market, it's either understanding, one, the more out of the box basic functionality that we can price appropriately for a smaller bank to say yes, or two, using a channel partnership strategy. So just announced a partnership with FIS, where FIS is going to be reselling our tech to medium and small size banks. And why that's important is number one, we get access to obviously the huge Rolodex of FIS's thousands of banks that our direct sales team doesn't have. And number two, FIS plays the role of customer success and customer support in that model. We're just the technology. And so it's a much more efficient way for us to still provide the elite technology to a medium and small size bank and a community bank, frankly, but it's more cost efficient because we're not playing that day-to-day customer success and customer support role like we do for the bigger banks.
Right. It's a special kind of pleasure to enjoy the procurement process as well as hosting enterprise software. So hats off to you for being able to weather it. So, just to kind of pull on two threads, the point around, and both of these are powered by big algorithms, right? So one is around fraud and making sure the person is real. And then second is the underwriting of the credit product. And both of these are big kind of mathematical algorithms that you have to fine tune. The more data, the better, and the more performant they get. Can you give us like order of magnitude flavor for how much, I don't know what you can share about like volume or users or sort of like what's the context of how much stuff you process for these types of products?
So just to clarify that last comment, so our fraud prevention module, highly sophisticated, been built off of hundreds of millions of applications, now partnerships with banks that have millions of customers. And so the data that's flowing through and making those fraud prevention capabilities smarter is really sophisticated. And then again, you add on the manual component that we still do today. The underwriting module is actually fairly simplistic, and that's intentional. The underwriting module, the bank owns their credit policy. So more often than not, the bank is dropping in their credit policy. We really think of underwriting and fraud prevention as two separate things. The underwriting module is simplistic, which makes it really easy for, again, the bank to stand up a program. So they're dropping in their credit policy. It comes pre-configured with obviously all the integrations you would expect with all the major credit bureaus, 40 plus different data providers that the bank can choose to use, leverage or not leverage, to really be that one-stop shop for that bank. And so they're both modules that the bank can either use or not use on a bespoke basis. But the credit underwriting module, somewhat simplistic, they're dropping in their credit policy and it comes pre-configured with all the integrations. The fraud prevention module is really the more sophisticated, where the daily data, the hundreds of millions of applications that we see flowing through the platform, is really continuously making that product smarter and providing more value to the bank.
Cool. Okay. Makes sense. All right. So this is sort of the evolution of digital lending. And now we've got a new packaging of digital lending in the shape of buy now, pay later. And sometimes you just need new words for old things, for those things to be like really cool. Apple is famous for inventing things that existed, 30 years ago, but making them mainstream and transformative. And so buy now, pay later is a new type or a new story about personal credit. Can you talk a little bit about what buy now, pay later is?
So we can talk about it certainly isn't a new product with a different wrapper that it has today. So buy now, pay later today means an innovative financing product that a customer can choose to take advantage of primarily online when buying goods. And so when you're buying something online, let's take actually one of our customers. So if you're going to NordicTrack.com and you're trying to buy a treadmill, on the checkout page, you're either going to be able to put in your credit card, as most customers do all the time, or you can take advantage of TD Bank's pay over time product. Typically either a split pay product where you can pay over 4 equal installments, or a longer installment, typically 1 year to 2 years pay over time. And that's what the quote unquote buy now, pay later products typically mean. That product typically has the exact same installment payment due on a monthly basis. And that's really where we've seen customers really adopt and like the product, because it's more transparent typically than carrying a balance in a credit card. It's typically more affordable because the merchant is typically incentivized to offer a lower APR and paying that bank at what's called a merchant discount rate in order to subsidize it. And 3, the customer can really budget against those equal monthly installments. And so because of that, it's really grown in popularity, still a fraction of the size of the credit card industry, but growing very, very quick. And so for Amount, sometimes it's a bit better to be lucky than good. At the end of the day, we've built an installment lending platform. And so installment lending platform that is extremely flexible from the standpoint of when you're going directly to a consumer. So if your bank looking to lend directly to your consumer, large unsecured personal loans, secured loans, small dollar loans, the platform can handle all of that. But also we recognize when buy now, pay later started to become a thing that our platform could also support going directly to merchants. And so it really allowed banks that have large credit card businesses, they were starting to see a lot of pressure with fintechs like Affirm and like Klarna come in and start to encroach in some of those relationships. And the merchant partners, because customers liked it, were asking their banks, hey, credit card's great, but we also want these other buy now, pay later, pay over time products. And so it was a great opportunity for us to go to banks and say, hey, this is an exploding asset class. It's going to take you years to build. We can get you in market with your merchant partners in 3 months. And there was a lot of pressure for them to do so they didn't lose that relationship. And so for us, really in the last year, we've seen buy now, pay later become about 50% of our sales pipeline, because every single bank is trying to figure out the right way to play. And because it's new, they don't have a ton of experience, they maybe need access to merchant partners. It's just really difficult to know where to begin. And so we've had a lot of success of holding both large banks' hands and smaller banks' hands, sometimes playing matchmaker with merchant networks, and to really provide them a path to really jump in and test this buy now, pay later ecosystem.
That's super cool and interesting. I've two questions on that, and I'll start with one and forget the other. So the first question is, you mentioned, and this is my understanding, is that one of the things BNPL companies are able to do and have used as a subsidy for the credit part of the business is drink from interchange, drink from a payments revenue pool. And so that is new, right? Like you can always buy an air conditioner for however many payments per month or whatever. That's not innovative. But dipping into interchange and finding additional revenue to subsidize the credit bit is different. And also, I think, probably opens up some opportunities for regulatory arbitrage, because are you really a lender if you're just getting paid on the payments and so on? Number one, like, is that true? And then second, has there been any implication for your software to have to integrate into new types of industry things that otherwise you wouldn't have had to touch?
So really what you're touching on in the interchange piece is really where I see the next wave of buy now, pay later going. And that's really when the card networks decide to really get involved here. Today, primarily the most notable buy now, pay later fintechs are going directly to the merchant and doing a one-to-one relationship. That obviously is starting to dip into the business that networks are seeing from an interchange perspective. And so that's really woken up the Visas and MasterCards of the world. Visa and MasterCard have both put out press releases recently that they're going to be playing in buy now, pay later, and really unlocking distribution at the card level for the customer to give them more choice. And so for Amount to really be a big part of that infrastructure for the card networks is certainly strategic and something that we hope to be. We think we can play a big role there as the card networks look to play in the US. They already are in other geographies, and so it's just a matter of time. But the encroachment on the interchange revenue because of these direct relationships that fintechs are doing with merchants has definitely woken up the card networks to this opportunity, as well as the growth of the asset class. So I agree with you that is real, that it will be the next phase of growth in this space, and Amount hopes to be a big part of that, to really connect the card networks to banks to stand up these installment programs, as well as, I think your second question was, plug them into other parts of the ecosystem like virtual card. We just did a big partnership with Marqeta, just announced it, and being the integration layer for a bunch of these sophisticated vendors that all together are providing that elite buy now, pay later experience. We're a big part of that journey, we think, for banks today, and hope to be there for card networks as well. I guess maybe your second question was around regulatory. 100%, there's going to be additional regulatory scrutiny coming into the space. That's also why we believe that banks are really well positioned for the space as well. In addition to the cost of capital advantages they have, the balance sheet advantages that most banks have, banks really understand risk management and regulatory management. And so by banks coming into the space, we think that the combination of that experience with our tech provides a really strong actor in this growing space, certainly.
Cool. I think I'm very interested in this idea of kind of the melting of all of the different fintech stacks together And there are different ways this is happening, whether it's packaged as embedded finance or whether it's vertical integration between different companies or kind of like consortia. So I want to double click on how you see the value chain starting to look in a world where you've got a partnership with Marqeta and maybe they've got a relationship with Visa and MasterCard and the card networks, and you do as well. But then there's a relationship with the banks. And then, like you want to have a direct relationship with the merchants in some sense, but also so do the card network. Like how does that value stack all shake out? Like who does what? Right? It's who plays what role once the stuff settles.
So today in our direct business, we aren't integrating directly with a merchant. We're not doing a partnership directly with a merchant. We know lots of merchant networks and we're playing matchmaker in many cases, but today it's really on the bank's BD team to go out and sell to those merchants. Our
What's
role.
a Sorry to interrupt. What's a merchant network? Is that like Shopify or like WooCommerce or like what is that?
So think about WorldPay as one example. FIS bought them a few years ago for about $40 billion, and a collection of a million plus merchants. That those merchants are going to be looking for innovative financing products. And so, an example where if a bank can plug in to that network in the right way, there's going to be certainly attractive assets that the bank can balance sheet as part of being a part of that network.
Gotcha. Okay, sorry, I interrupted you. So we're talking about what a value chain could look like once sort of the big commerce players from the payment side, as well as the credit and BNPL players, as well as the traditional banks. Once the stuff is a little bit more clarified, how does that value chain look?
Yeah. So today I mentioned, so we're really the tech provider. The banks are then taking that technology and going to merchants. So we're effectively, for lack of a better term, the arms dealer to the bank to provide them that buy now pay later solution, fully integrated with all these different vendors like a Marqeta with a virtual card product. And then the bank's BD team is going directly to a merchant and saying, hey, we already have a credit card relationship with you. Here's a buy now pay later product that you either can brand in your name, in our name. We can plug it directly into the rewards platform that we probably already have and be live in 3 months. And so today that's really powerful for the bank. The risk to Amount in that scenario is, we don't control the sales cycle. And so we control the sales cycle of selling into the bank. But in terms of actually scaling that product, it's really the onus on the bank sales team to go out and be selling that product into these merchant partners. Where we see this going is exactly what I just mentioned. There are lots of merchant networks out there where we think we can be the layer that really brings these large merchant networks, instead of just a one-to-one relationship, into the bank ecosystem that we're starting to drive. And why that's going to be value add for the merchant network is that they're going to get access to cheap financing products that they can offer to their customers. And why that's value add for banks is that they're going to immediately get immediate scale and access to these merchant partners versus their sales team pounding the pavement and going out and selling these individual merchant partners. And so today it's very much one-to-one. But whether it's us plugging directly into these merchant networks, whether it's us playing a role with the card networks as they step into buy now pay later, there's a big opportunity for scale with Amount playing the connecting layer between a various network and the bank ecosystem that we have on our platform.
Got you. That's fascinating, and I think it makes a ton of sense for how this stuff can shake out. We lightly touched on the regulatory question, and so I want to double click on that as well in terms of what are the pivots around the regulatory questions. Like what are the things that are not well defined or maybe that are to some extent controversial. And I guess in part attached to that question is who's doing the underwriting, whose capital is this really, who's taking on the risk, and what's happening to the credit. What parts of that are you seeing, and how is that going to change?
Yeah, so there's already been significant regulation in other geographies like the UK and Australia. I would expect that to happen here as well. And a lot of that is going to be around the question of affordability. Today, this is an asset class that's growing rapidly. It's unclear around the data that can be used from an underwriting perspective, things like soft pulls and hard pulls, affordability in terms of stacking of these products for a customer. And that's really where I go back to a bank is really well positioned, not alone, but when you pair it with our tech, you layer on all these big bank principles around underwriting and risk management and the data that they already have, it makes a really good marriage for a market product that is highly sustainable because they have, years of experience and do it really well in terms of growing various asset portfolios. And so by layering that experience with our tech, we think it's going to be really compelling for the banks to jump in a big way in buy now, pay later as the new exploding asset class. And so it's still a bit TBD, but my expectation is that regulation will increase here. The focus is going to be around layering on some additional standards, especially around affordability. And again, my view is that banks being a bit more conservative in most cases are going to be really well positioned to meet the bar there.
Yeah, and I can definitely imagine the world, or continue to see the world as the broad pools of capital sitting across the mega banks, and then certainly some in the long tail powered by the core banking platforms, and then lots and lots of smart software sitting on top, intermediating, back to the customer and back to the consumer footprints. But for a couple of, I think, larger players who are able to be vertically integrated and do still build their own software, most of the leading, maybe that's not entirely fair, but some of the very best software ends up being industry level solutions. And certainly that's something that you and your team are very clearly building. I want to thank you for hopping on the podcast with me today, and just ask if our listeners want to learn more about Amount or learn a little bit more about you, where should they go?
Yeah, no, Lex, it was a real pleasure. Really enjoyed the conversation. Amount.com, that has all the information around our solutions in retail lending and buy now, pay later, as well as a bit more about our story that banks, non-bank financial institutions, other partners can really learn more about us. I'm on LinkedIn. That's the best way to get a hold of me. And so I would really encourage your listeners and other partners to reach out on LinkedIn, and I'll respond personally or plug you into the right person in the organization to get your question answered. But overall, it's the website. We spend a lot of time there, as you have to, and in again the digital world to ensure that our solutions are highlighted properly.
Awesome. Thank you so much for coming on.
All right, Lex. Thanks again.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.